AT&T's Cost of Capital by Francisco Lopez. Question 1 asks, how much interest-bearing short-term debt did AT&T have at the end of 2009, and what was the average cost of this debt? AT&T had $7,361 in short-term interest-bearing debt, which had an average cost of debt of 8.03%. This was calculated by taking the interest expense on the balance sheet and dividing it by AT&T's total debt. Question 2 asked, what was AT&T's actual capital structure at the end of 2009, based on its consolidated balance sheets? What portion of AT&T's capital structure did short-term debt, long-term debt, and stockholders' equity represent in 2009? And short-term debt will be defined as the total debt maturing within 1 year, and long-term debt will be the figure given in the consolidated balance sheet. AT&T has 38.07% of its capital structure financed by equity, while using the other 61.93% financed by debt. Its short-term debt represented 2.74%. Its long-term debt represented 24.08%. And its stockholder equity represented 38.07%. Question 3 asks, now calculate AT&T's capital structure just using long-term capital, in other words, long-term debt and common equity. Use your results from previous questions to accomplish this. Calculate the long-term debt to total long-term capital ratio and the common equity to total capital ratio. AT&T's long-term debt to total long-term capital ratio was 38.74%, and their common equity to total capital ratio was 61.26%. Question 4 says, assume that AT&T wants to issue fixed-rate 10-year bonds. If their investment banker tells the firm that they can do so at a spread of 1.5% greater than the equivalent maturity Treasury security, what would AT&T's before-tax cost of this long-term debt be? If AT&T were to issue fixed-rate 10-year bonds with a 1.5% premium of the Treasury, which is 1.75% as of now, they would issue the bonds with a 3.25% before-tax cost. Question 5 says, review AT&T's 2000 notes to consolidated financial statements. Examine the note on income taxes. Use the average tax rate for 2009 listed in the financial note as an estimate of AT&T's relevant marginal tax rate to calculate the after-tax cost of short-term debt and long-term debt. The after-tax cost of AT&T's short-term debt is $2,576.35, whereas their long-term debt would be $22,652. Question 6 says, apply the capital asset pricing model security line to estimate cost of capital for AT&T. Assume a market risk premium of 7% and use the ass yield on a 10-year T-bond as an estimate of the risk-free rate. Get a beta estimate of AT&T from online sources. Using the CAPM formula and using a 1.75% risk-free rate, 0.45 beta, and the given 7% market risk premium, I calculated that AT&T has a cost of capital of 4.9%. The presented graph is a graph of the security market line.